Right now, I want to bring in Brian Levitt, Chief Market Strategist at Invesco. Brian, good luck. Take everything you just heard, all the data you just got, and tell me what you'd be doing in the market these days.
I actually found it all to be pretty enticing for the market. So what you're looking at
data or
the data in general. I mean, clearly it's a slowing economic environment. When you
why is that enticing? Because it brings the Fed back in?
Yeah, it's still resilient. Inflation expectations are contained. So if you're looking at a 4% Treasury rate, what is that telling you? It's telling you the real yield's at about 1.5%. So that's weaker growth. Inflation expectations remarkably stable at 2.5%. So we're in a mid-cycle slowdown. The expectation is the Fed lowers rates. You get a reacceleration, not to a new higher level of growth, but back towards more of a trend-like growth environment. And that should be conducive for risk assets.
And that means you look at the slowing job market as something that entices the Fed back in to ensure you to get another cut, but you don't think it's a serious slowdown? Because if you did, it might change your opinion.
Yeah, that would change my opinion. And if it was a serious slowdown, I think I would be seeing things like credit spreads blowing out, bankers tightening lending standards, end of cycle stuff. In fact, what you're actually getting globally is leading indicators picking up a bit. And if you look 2023 to 2025, the global leading indicators have been remarkably stable but below trend, which is why it's been really a mega cap growth type of environment. So the expectation now is lower rates, fiscal support around the world, pickup in global activity, which can all help to potentially broaden out this market a bit.
We've had several guests who have come on even today and suggested that they are looking at the other parts of the market that have been neglected, the value sectors, versus what's happening in technology. It sounds like you are kind of leaning into that, the same thing you just said.
Yeah, all those parts of the market need a catalyst. So whether it's the international markets, value, smaller capitalization, all of that needs a catalyst. And the catalyst would come by the way of policy easing and a pickup in activity and perhaps some weakness in the dollar. Now, that was the hope coming into this year, and it seemed like we were heading there, certainly in the international markets. Liberation Day likely delayed that because it stalled Fed easing. So that's why I've been focused so much on inflation expectations in this period. We know headline inflation is going to tick up a bit, but with inflation expectations modest, real yields coming down, to me that signals rate cuts, and that signals you couple the rate cuts with fiscal policy in other parts of the world, that should be a better economic outcome.
And what does that mean for the end of this year, the beginning of next year? We've seen a lot of volatility in the market. That's going to continue?
Yeah, no, I think it's actually a better risk environment with less volatility. The volatility, I mean, everybody was so focused on the AI trade, but volatility is almost always the result of policy uncertainty. And if you start looking at when things like Bitcoin sold off, when non-profitable tech companies sold off, you could almost time that to Jerome Powell saying there's diverging views at the Fed.
Okay.
And you started to find a bottom when you started to get some indication that maybe December's back in play. And so if you can, you're right.
Well, that's an excellent point. Just the idea that the credit markets and the private credit markets were the ones that were really kind of shaky on that idea, because a lot of that debt has been written on the idea that rates are going to come down.
Exactly, precisely. And so this gives, we talk about these reports. No, I don't want to see payroll slowing. I don't want to see retail under duress. But there's a different story from a macro perspective versus what it ultimately means for the stock market.